Business time now. Should we join Mariam?
Mariam's over there. Hello, Mariam.
Hi, thank you very much. Yes, well, it was widely expected and the Bank of England didn't fail to deliver today. Interest rates have been cut by 0.25% to 5%. Worries about a slowing economy taking precedence over efforts to curb inflation. Well, under normal circumstances, the move would mean cheaper mortgage rates from banks, while savers could expect leaner pickings. But it appears we can throw the rule book out of the window while the credit crunch continues. So how have the lenders reacted to today's cut? Well, let's speak now to Robin Amlôt. He's senior editor of the financial advice website. It's moneyextra.com. Robin, thanks for joining us. I wanted to start by asking you, what have the mortgage lenders done today? Where have they moved? Have they cut their SVRs, their standard variable rates?
Well, quite a lot of them haven't actually done anything, of course. What has happened is that the big names have moved, the likes of Barclays, Woolwich, Lloyds TSB, Cheltenham and Gloucester, HBOS, Halifax Bank of Scotland, RBS, Royal Bank of Scotland and NatWest and Britannia. They've all cut their standard variable rate, or in Nationwide's case, for some reason they call it the base mortgage rate, by 0.25%. They've passed the full cut on, in other words. But what happened at the same time, of course, over the last few years, is that less and less of us are actually going to be affected by that because we're all on special rates. Therefore, we aren't going to see the benefit of that cut, even if we're with one of the lenders who has already cut.
And a standard variable rate is invariably a lot higher now than the actual rate of the interest rate itself, isn't it? So it doesn't make a huge amount of difference.
Well, the standard variable rate now, on average, is around 7%. We have an interest rate from the Bank of England of 5%, which takes us back to where we were in January of last year. Now, the problem is, of course, that we have a growing disconnect between the official interest rate, the 5% base rate that the Bank of England has given us, and the market rates. More and more lenders are moving away from that. They're increasing the margin, whether it's on the standard variable rate, whether it's on a tracker rate, whether it's on a fixed rate. They're far more expensive than they were when base rate was last at 5%.
So what do we need to do? What advice do you give?
The advice I'd have to give to people is grin and bear it, because we all have to pay our mortgage if we've got a mortgage, and there are very nearly 12 million mortgages in the country. If you are shopping around for a new mortgage now, look for the best deal you can, but do be aware that if you go for some of the special fixed rate deals that are currently on offer, you're going to pay a hefty, hefty fee. For example, today, before the base rate announcement, we had two lenders increase their fixed rate offerings, Nationwide and Alliance and Leicester. Now, these people aren't silly. They knew base rate was coming down.
And you're paying higher arrangement fees, aren't you, nowadays, too?
Well, the Alliance and Leicester, of course, they don't charge a fixed arrangement fee. It's 2%. Now, 2% doesn't sound a lot, but if you're on a £100,000 mortgage, that's £2,000 you've got to find.
It's a lot of money, isn't it?
It certainly is.
OK, Robert Amlôt, thank you very much indeed for coming and talking to us this evening. And that is a roundup of the business from me. Back to you.
Mariam, thank
you.
It's